In this video, I'm going to walk you through the statement of comprehensive income for several companies. First, we'll look at a company that manufactures consumer packaged goods, Procter and Gamble. The first line of Procter and Gamble's statement of comprehensive income is net income from the income statement. Note that this is consolidated net income, which includes income from non-controlling interests. Income from non-controlling interests will be subtracted later. Several adjustments are then made to go from net income to comprehensive income. The adjustments are called other comprehensive income, and they're either added or subtracted to net income in arriving at comprehensive income. So let's look at those adjustments. The first adjustment is due to a gain on foreign currency translation. Procter and Gamble said that the financial statements of its foreign subsidiaries are measured in the local currency of those countries. When those financial statements were translated back to the US dollar, this resulted in a gain, and Procter and Gamble reported that gain as other comprehensive income. This means the gain increased stockholders' equity but had no effect on net income. And if you dig a little bit deeper in Procter and Gamble's annual report, you'll see that this gain was actually netted against a loss on a foreign currency swap. The unrealized gain from the foreign currency translation and the loss from the swap were netted together to yield other comprehensive income of $1.023 billion. Now, the second adjustment has to do with an unrealized gain on investment securities. Procter and Gamble had an unrealized gain on a debt security. This had no effect on net income, but it does affect comprehensive income. Thus, $16 million was added to net income in arriving at comprehensive income. Now, the third adjustment is due to an unrealized gain on defined benefit retirement plans. There are actually two components to the defined benefit retirement plans: payments made to retirees and other retiree benefits, like the cost of providing medical insurance to retirees. Procter & Gamble said there was an actuarial gain for both of these. The gain for the pension payments was due to increased discount rates, as higher discount rates result in a lower projected benefit obligation. The gain for other retiree benefits was due to, quote, favorable medical cost trends. Now, the total unrealized gain related to Procter & Gamble's retirement plans was $1.386 billion, and this amount was added to net income in calculating comprehensive income. Note that each type of comprehensive income is presented net of tax. Now that we've made the three adjustments to net income, the final step is to subtract $50 million, which is the comprehensive income attributable to non-controlling interests. This yields the comprehensive income attributable to Procter & Gamble, $16.7 billion. This is more than $2 billion higher than Procter & Gamble's net income, so it's not a trivial difference. Now, there aren't a lot of accounts that flow through other comprehensive income, so you'll see a lot of similarities when you look at statements of comprehensive income for different companies. Walmart, for example, reported other comprehensive income from foreign currency translation and from changes to its pension liability, just like Procter & Gamble. Walmart didn't report any unrealized gains on debt securities, but it did report other comprehensive income for investment and cash flow hedges. Apple reported other comprehensive income for foreign currency translation, unrealized gains and losses for debt securities, and unrealized gains and losses related to derivatives. Warren Buffett's company, Berkshire Hathaway, reported other comprehensive income from foreign currency translation, unrealized gains and losses on debt securities, and pension plans. Thus, what you're most likely to see in a statement of comprehensive income are unrealized gains and losses related to foreign currency translation adjustments, pension plans, derivatives, and unrealized gains and losses on debt securities.